What is inflation? Inflation makes money lose its purchasing power over time. With other words, inflation is the rise of prices for goods and services as time passes. This means that with the same amount of money, we can buy less in the future than today. For example, if you spend $100 on groceries today and inflation is 3% a year, you might have to spend $103 next year for the same items. There are several theories explaining the causes for inflation. The two most important are demand pull and cost push inflation. Demand pull inflation occurs when demand for goods and services exceeds supply, leading producers to increase prices. Cost push inflation happens when rising production costs, like higher raw material prices, cause producers to raise prices. Central banks are responsible for managing inflation. As long as inflation is low and stable, which is defined around 2% per year, they are happy. However, when inflation gets out of hand, they will take action. If inflation is too high, they will increase interest rates, and inflation is too low, they will decrease interest rates. Why does inflation matter to investors? Investors should always judge the success of their investments after adjusting for inflation. For example, if you invest $100 today and it grows by 7% to $107 in a year, it might look like a great return. But does that mean that we can buy 7% more goods and services? To find out, we need to adjust the return for inflation. Let's say inflation is 3%. We start with our 7% return, subtract 3% inflation, leaving us with a real return of 4%. So even though we have 7% more money, it will only buy 4% more things. The key takeaways are: first, inflation is the rise of prices for goods and services over time. Second, always consider inflation when evaluating investment performance. Otherwise, you might overestimate how much your wealth is truly growing. This has been Inflation in 100 Seconds. Hit the like button if you want to see more short videos like this. Thanks for watching, and I will see you in the next one.